Silver at $108. Let that sink in. Because in most eras, silver lives in a world where a $2 move is a big day, a $5 move is chaos. And anything beyond that is the kind of action that forces the entire market to reveal what it's really made of. As of early January 27, 2026, multiple live pricing feeds have shown spot silver trading around $110 and change, with reports of a run toward 108 nights, and even a brief spike above 117 in the same violent surge. Read that again in plain language. Triple-digit silver, in real time, with swings that look less like a bull market and more like a stress test. And here's the part that matters most. This kind of move can be bullish and still be dangerous, because the same ingredients that create a melt-up, thin liquidity, leveraged paper exposure, and a scramble for physical supply are the same ingredients that can trigger the next crash ahead. Not a gentle pullback, a sudden air pocket, the kind of drop that happens fast enough to make people think something broke, even when what actually broke was leverage. So ask a simple question. What exactly is being priced right now? Is it silver, the metal, or is it urgency, the cost of getting silver right now in the real world without waiting? The answer is both. And when a market starts pricing urgency, price moves can become violent in both directions. To understand why, the plumbing has to be understood, not the headlines. There is spot pricing, the theoretical price for immediate settlement. There are futures contracts, paper agreements for delivery later, traded on exchanges. And there is the physical market, bars, refinery output, industrial procurement, premiums, shipping delays, and regional shortages. Two venues matter in how the price gets broadcast. COMEX, the U.S. futures, exchange ecosystem where enormous volumes of paper silver trade. And the London wholesale ecosystem often associated with LBMA conventions, where global bullion flows and pricing references are anchored. When those systems are calm, it feels like one clean price exists. When those systems are under strain, prices fracture. And one of the clearest signs of fracture is regional premium. Recent market reporting has pointed to silver in Shanghai trading at a premium of over $14 above London benchmarks. $14. That is not noise. That is the sound of a physical bid pulling hard enough to bend the global pricing structure. So connect the dots for a second. When one region is willing to pay $14 more than another region for the same metal, what does that imply? It implies that leverage is not the only driver. It implies that physical availability and the difficulty of sourcing it is becoming part of the price. Now, here's where it gets really interesting. A lot of people assume the crash comes after the top is obvious, after euphoria, after every mainstream headline catches up. That's not how leveraged markets usually break. They break from mechanics. A margin change, a liquidity pocket, a wave of forced selling, a moment where buyers hesitate and sellers become urgent. And silver is uniquely vulnerable to that because it is a hybrid market. Monetary narrative on one side, industrial necessity on the other, paper leverage sitting on top of both. Start with margin, because margin is the invisible hand that forces behavior. In futures markets, the full value of the contract is not paid up front. A deposit is posted, margin, and the exchange can raise it when volatility increases. A standard COMEX silver futures contract represents 5,000 ounces. At $110 an ounce, that is roughly $550,000 of notional value for a single contract. Most participants are not fully funding that. They are using margin, and when silver goes parabolic, margin risk goes parabolic with it. CME margin data has shown large initial margin requirements for silver contracts. Figures around $45,000 have been cited for certain contract months. And CME has also discussed approaches where margins are expressed as a percentage of contract value. Translation: when price rises fast, the cost of carrying a leveraged position can rise fast too. That matters because it knowably triggers a specific chain reaction. Margin rises, accounts need cash, cash doesn't appear, positions get reduced. Reduction becomes selling, selling becomes more volatility, more margin pressure. And suddenly the crash is not driven by bad news, it is driven by forced de-risking. Stop, and think about how that looks on a chart. It doesn't look rational, it looks like a trapdoor. That's why the warning matters. Triple-digit silver can feel like victory, while also being the most fragile phase of the move. Now, step back from paper structure and look at the physical picture. Silver is not cheap gold. Silver is also a critical industrial input, used in electronics and high-tech applications, and often pulled through supply chains that do not adjust quickly. According to the World Silver Survey 2025, published by the Silver Institute with research by Metals Focus, industrial demand reached a record roughly 680 million ounces in 2024, and the market recorded a deficit of roughly 148 million ounces for that year. A deficit means demand exceeded supply in that period, and that difference has to be met somehow. Inventories get drawn down, recycled metal increases, investment supply shifts, or demand gets priced out. But while the system is adjusting, the buffer gets thinner. And when buffers get thin, price discovery becomes unstable. That's when regional premiums become louder. That's when lease rates get attention. And that's when paper pricing can whip around while the physical world refuses to relax. Recent reporting has also discussed silver lease rates around 3%. And in plain language, that implies tightness has a cost because lenders can charge more to make metal available. Is that permanent? Not necessarily. But it is a signal, and signals matter most right before markets snap. Now add the macro backdrop because silver doesn't move in isolation. Gold has been reported above $5,100 in late January 2026 trading windows, with silver above 109 in the same wave, amid geopolitical and policy uncertainty. That kind of backdrop can bring safe haven flows into metals. And it can also trigger a separate dynamic, cross-asset deleveraging. Because when fear rises, sometimes everything is sold to raise liquidity, even assets that are supposed to go up. That's how weird market days happen. Gold down on a panic day, because cash is king for a moment. Silver down even harder, because silver is gold with a turbocharger, higher volatility, more leverage sensitivity, and more industrial demand elasticity at extreme prices. So now the core question becomes simple. Is this move pricing long-term scarcity or short-term stress? Because short-term stress can push price higher and then immediately reverse when the stress is relieved, or when leveraged players are forced to exit. That's the crash setup. Here's the part that should make attention sharpen. When a market is truly strong, pullbacks happen with a specific character. Buyers step in quickly and price stabilizes above important trend levels. When a market is fragile, pullbacks cascade, supports fail, bounces are weak, and liquidity thins. And in a parabolic regime, the difference between those two outcomes can be just 1 or 2 sessions. Now define 2 terms that will show up if the market keeps acting like this. Contango, when futures prices trade above spot, often reflecting carrying costs. Backwardation, when spot trades above futures, sometimes signaling near-term tightness or urgent immediate demand. These structures matter because they hint at whether the market is paying extra for right now, and right now is where stress lives. Another set of lumbing terms matters too. Open interest, how many futures contracts are outstanding. Delivery notices, signals tied to delivery intent. Registered inventories, exchange-designated metal eligible for delivery under exchange rules. When those metrics tighten while price explodes, The system becomes sensitive to any change in incentives, including settlement behavior. This is not mystery. It is how markets clear. Now, the historical mirror. Not because history repeats perfectly, but because it shows what parabolic metals can do to human behavior. In 1979, silver began the year around $6 an ounce. By January 1980, it reached roughly $49, with intraday peaks around $50. And then it crashed, not softly, violently. That episode involved unique factors, including concentrated positioning and changing rules, but the rhyme is the same. Parabolic price action builds fragility, and fragility breaks from pressure, not from logic. So no, 2026 is not 1980. But the lesson still applies. Silver can crash in a bull market, and often does. Now, give the bearish case cleanly, because holding the bearish case is how risk is managed. Here is the bearish case. Triple-digit silver can be a blow-off move, a climax driven by late chasing. At extreme prices, industrial demand becomes more price-sensitive. Procurement gets delayed, substitution gets explored, budgets get rewritten. Regional premiums can narrow quickly if policy shifts, if local demand cools, or if arbitrage channels open more smoothly. Lease rates can fall if tightness is alleviated. Exchange margin pressure can trigger forced liquidation, which can look like a fundamental reversal even when nothing fundamental has changed. Holiday liquidity pockets, including periods around major regional shutdowns such as Chinese New Year slowdowns, can amplify moves and reduce the ability of the market to absorb selling. And most importantly, silver's normal behavior includes large percentage drawdowns. A 20% correction is not an anomaly in silver. It is part of the personality of the market. So yes, the next crash ahead could be real and could be violent and could happen without warning. That possibility has to be acknowledged. Now, the bullish reinforcement, without pretending risk, disappears. Here is what those risks don't change. They don't change the data showing sustained physical tightness in recent years, including the reported 2024 deficit and record industrial demand in the World Silver Survey 2025. They don't change the meaning of an extreme regional premium, because $14 is not a casual premium. It is a sign that at least one major market is valuing immediate supply differently than the paper reference suggests. They don't change the reality that forced liquidation events can clear leverage out of the system, and sometimes that reset becomes the foundation for the next leg higher. This is where discipline matters, because panic interprets every drop as the end. Discipline interprets the drop as information. What breaks? What hole? Do premiums collapse or do they stay stubborn? Does physical demand step back, or does it keep bidding quietly while paper sells loudly? Do technical levels reclaim quickly, or do they fail repeatedly? Those answers arrive in real time during volatility, and they matter more than any confident headline. So what should be watched? Not bought, not sold, watched. Start with the regional spread. If Shanghai stays meaningfully above London, even during paper pullbacks, that supports the idea that physical urgency remains. If that spread narrows sharply, it signals easing stress. Watch lease rates as another tightness indicator. Elevated rates imply scarcity has a price. Falling rates imply scarcity is easing. Watch margin updates and broker requirement changes, because margin is what forces the market to reveal where leverage is hiding. Watch volatility regime, because volatility is what turns a normal correction into a cascade. And watch the chart with one specific mindset. Charts are not prophecy. Charts are crowd behavior made visible. In parabolic moves, the most important concept is mean reversion. Price can float far above major moving averages longer than expected, and then snap back faster than expected. The question is not whether a pullback happens. The question is whether the pullback is absorbed or becomes a stampede. Now, Speak to different types of participants because one-size thinking is how people get hurt. For physical holders, the risk is not just price, it's also liquidity, premiums, and emotional decision-making. Physical is not a day trading instrument. Time horizon and cash needs matter more than daily candles. For short-term traders, the enemy is leverage and narrative attachment. In a triple-digit regime, overnight moves can blow through levels, spreads can widen, and sudden margin changes can turn a good thesis into a forced exit. Risk controls are not optional here. For newcomers, the enemy is FOMO. When a chart goes vertical, the brain screams late, but the market does not reward urgency without a plan. The smarter move is understanding basics first: spot versus premiums, physical versus paper, volatility as a feature, not a surprise. For long-term macro watchers, the job is to separate cause from catalyst. Macro stress can ignite a move, but sustainability depends on whether physical supply chains and demand can coexist without breaking, and whether the system can handle the pressure without forcing widespread liquidation. Now bring it all together. Silver around 108 to 117 in a short window, spot prints around 110 and change as of early January 27, 2026. Reports of a Shanghai premium over $14, discussion of lease rates around 3%, and a physical market context that includes a sizable reported deficit and record industrial demand. This is not a normal market. This is a market where small changes can cause big moves. A margin update, a holiday liquidity pocket, a sudden narrowing of premiums, a burst of profit-taking, a macro headline that triggers cross-asset selling, one of those can be enough to start a cascade, not because silver became bearish, but because leverage became vulnerable. So here are the three most important truths to hold in mind, and hold them at the same time. First, parabolic silver is not just opportunity, it is fragility. Second, physical stress signals matter more than social confidence. Third, a crash does not automatically kill a bullish thesis, but leverage can make it feel like it does. Now the verification piece, because independent checking is how confidence becomes real. Compare multiple live spot feeds rather than trusting a single screenshot. Check CME's published margin data and any updates to requirement methodology. Read the World Silver Survey 2025 for supply and demand framing. Track regional premiums where possible, because premiums reveal stress that paper charts can hide. And now, full risk disclosure, plainly. This is educational information, not financial advice. Silver is extremely volatile, especially in high-price regimes. Prices can reverse violently and without warning. Exchanges and brokers can change margin requirements and risk controls, which can force liquidation. No outcome is guaranteed. Position sizing matters, risk tolerance matters, time horizon matters. So yes, a silver at 108 can be the beginning of a new era, and yes, the next crash ahead can still arrive first, because the real warning is not that silver can't go higher. The real warning is that once triple-digit silver starts feeling normal, that's usually when the market reminds everyone it never was.